Welcome back to the Pro Ticker Podcast, your Monday morning edition covering major financial magazine headlines, everyone. We have assembled a really dense stack of reports for this deep dive. And they reflect an environment that is just deeply split between this incredible long-term optimism and some very immediate, very real geopolitical friction.
Absolutely. And our mission today is to cut through that noise, right? We're looking at reports from CNBC, Bloomberg, Reuters to really understand why professional investors are, or maybe more importantly, aren't worried right now.
Exactly. We need to unpack the health of the AI trade. Is the conviction real, or are we staring at a bubble? Then we've got the wild volatility in the crypto market. And finally, breaking down all these fiscal and geopolitical tensions from the UK's budget to these US-China corporate allegations.
It's a lot. The signals are profoundly mixed. Volatility is high, but the conviction in certain trends, especially in large cap tech, seems surprisingly durable.
Okay, so let's start there, the tech sector. Because the air does feel a little thin, the NASDAQ just had a choppy stretch, and you hear this constant drumbeat about an AI bubble, especially with the massive concentration in the Magnificent Seven stocks.
That concentration fear is very real. I mean, for anyone not familiar, the Mag 7, that's your Apple, Microsoft, Alphabet, Amazon, they are driving the vast majority of the S&P 500's gains. But when you listen to the titans of private capital, the people at the CNBC delivering Alpha conference, they're sending a completely different message. They are not worried.
And we're talking about heavy hitters here. Bill Ford of General Atlantic, who manages, $118 billion, and Philippe Laffont from Coatue Management with $71 billion. So what's their core argument? Why isn't this just another dot-com bubble?
Laffont laid it out perfectly. He called it the hyperscaler advantage. The big difference now is simply financial stability. These top companies, Alphabet, Microsoft, Amazon, are on track to produce nearly $1 trillion of annual free cash flow.
Wait, $1 trillion? Okay, let's stop there and define free cash flow, because that detail is it's the whole story.
It is. Free cash flow, or FCF, is the cash left over after a company pays for everything, all its operations, all its new equipment. It's the pure profit engine. Back in 2000, those dot-com companies had huge valuations, but, no FCF and tons of debt. Today, the Mag 7 are generating this massive cash pile, and crucially, they have virtually no significant debt. That's the safety net.
So the thesis is this isn't speculative hype. It's backed by the biggest, safest balance sheets in the world.
Precisely. Bill Ford said the incumbents are the ones actually driving the AI change. General Atlantic is pushing AI across its entire portfolio of 200 companies, and he says they're already seeing a pretty high payback.
In real-world applications.
Yeah, things you can measure. Better customer care, faster coding, more effective digital marketing. The profits are tangible.
That conviction is so strong, it even pulled in a name I was surprised to see, Warren Buffett. Berkshire Hathaway just revealed a new stake in Alphabet.
It's such a great full-circle moment, isn't it? Because you might remember, back in 2019, Buffett said they had screwed up by not buying Alphabet when it was around $59 a share.
And now it's over $276.
Yep.
So he's finally in. The confidence is clearly there at the highest levels.
It is.
But I have to ask about that Oracle example Laffont brought up, because it was jarring. He pointed out Oracle stock swung from $150 to almost $350, then fell all the way back to the 220s. If a giant like Oracle can swing nearly 100%, doesn't that prove that hype is still driving things, regardless of the underlying cash flow?
It's a great point, and it acknowledges the reality of the market. Laffont basically conceded that, yes, public stock prices can get way ahead of the fundamentals. But his argument is that the long-term vision is intact. He believes the elasticity, what you can do with cheaper compute tokens, is almost infinite. So he sees strong growth supporting these giants for a decade, maybe more. The volatility is just a pricing adjustment. The FCF is the anchor.
An anchor. I like that. Okay, so that's a sense of safety in AI. But let's pivot to a corner of the market where there's absolutely no anchor, the pure chaos of crypto volatility.
Chaos is the right word. I mean, Bloomberg reported Bitcoin fell below $100,000. That's a loss of about 25% from its recent high of $126,000. And it wiped out something like $600 billion in market value.
Okay, a $600 billion loss needs some context. What's driving this massive liquidation?
It's a mix of things. Three main factors, really. First, you have renewed U.S.-China trade tension, which made traders pull back on risk. Second, Institutional money flowing into the new crypto ETFs slowed way down. That's because macro liquidity is tightening. There's just less free cash in the global system.
And the third factor.
The third is psychological. It's the fear of the 4-year halving cycle.
Explain the halving cycle. Why does it scare people?
So, the Bitcoin protocol is designed to cut the reward for miners in half about every 4 years. Historically, this creates a boom-bust pattern. Prices surge after the halving, but then big money gets scared of the correction that always seems to follow. We're seeing that fear play out right now.
So is this another 2022 style collapse?
Well, the bullish counterpoint is that this is a liquidity reset, not a loss of belief. There are no systemic failures like last time. The advice for long-term buyers is to just ignore the short-term noise and watch for when global macro liquidity starts to loosen up again.
Now, despite all that financial chaos and the whole narrative around Bitcoin's energy use being so negative, I found one of the most surprising stories in the sources. It's about what to do with all the waste from Bitcoin mining.
And it is enormous waste. We're talking about 100 terawatt hours of heat generated every year.
Which means nothing to me. Give me some scale.
Okay, to put that in perspective, that's enough wasted heat to warm every single home in a country the size of Finland. All of it just goes into the air.
But not for everyone. We found this real-world example, a company called Softwarm in Idaho. They're using miners to heat commercial spaces, things like car wash bays and these huge industrial water tanks.
Right, and the claim is that the miners are so effective they actually produce more money in Bitcoin than the cost of the energy to run them.
Which would make the heat totally free.
That's the pitch. Now, the big question from critics is whether this can actually scale. Skeptics argue that commercial mining is so specialized now that home devices are useless for profit. They say these crypto heaters are just inefficient space heaters taking advantage of people's hope.
But on an industrial scale.
On an industrial scale, proponents see a real convergence of digital and physical energy systems. The heat becomes a valuable output, not just waste.
So if crypto is decentralized chaos, let's move to highly centralized risk. Global government and fiscal news. Starting in the U.S., the 43-day government shutdown is over. And now we are just bracing for a massive data dump.
Yeah, bond traders are focused on this all week. The really critical report, the make or break one, is the delayed September non-farm payrolls report. That's out on Thursday. And that data is absolutely crucial for confirming the true health of the U.S. labor market.
Which in turn tells us if the economy is heading for a hard landing or not, and what the Federal Reserve does next.
Exactly. We've already heard cautious comments from Fed officials, and investors have lowered the odds of a December rate cut. The market now sees about a 56.1% chance of the Fed just standing pat, keeping rates right where they are.
And there was some drama inside the Fed itself. An ethics report came out about former Governor Adriana Kugler.
A big deal. It revealed she violated trading rules, buying individual stocks like Apple and Caterpillar. And critically, she was trading during the FOMC blackout periods.
And just to remind everyone, the FOMC is the committee that sets interest rates. A blackout period is when trading is strictly forbidden to prevent any hint of insider dealing.
It's a core issue, and her abrupt resignation conveniently allowed President Trump to appoint Stephen Miran as her replacement. It just highlights the political sensitivity there.
Meanwhile, across the pond, the UK has its own fiscal nightmare. Chancellor Rachel Reeves is trying to plug a $50 billion hole in the budget. Why is that specific number so important to the markets?
It's all about credibility. The UK has to stabilize its finances, and fast. Gilt investors, the people who buy UK government bonds, they're demanding reassurance after all the recent volatility. The sources suggest she's going to have to make some very unpopular choices, probably a mix of tax hikes, maybe on dividends, and some deep spending cuts. She has to deliver a credible budget.
And finally, let's talk corporate geopolitics, because the temperature is just boiling. We saw a White House memo alleging that Alibaba is providing tech support for Chinese military operations, against U.S. targets, no less.
A really serious, direct allegation. For its part, Alibaba categorically denied it. They put out a statement calling the claims completely false. They also sort of questioned the timing, suggesting the anonymous leak was intentionally planted to undercut President Trump's recent trade deal with China. The environment is just tense.
And that tension is spilling directly into the Asia-Pacific markets. The report showed some pretty mixed news, especially out of Japan.
Yeah, Japan's economy just contracted 0.4% quarter on quarter. That's the first contraction in 6 quarters. It was driven by sharp drops in private demand and a really dramatic 9.4% fall in residential investments.
And on top of the economic pain, there's political friction with China.
A lot of it. Beijing issued a travel advisory for Japan, and that just hammered tourism-exposed Japanese stocks. Shiseido, the beauty company, was down over 9%. Seiten Mitsukoshi department stores lost more than 11%.
So you could draw a straight line from a geopolitical headline to a stock price.
A very clear line.
Meanwhile, the U.S.-China trade flashpoint. It's still all about soybeans. U.S. farmers are waiting for these big sales that just aren't happening.
China is absolutely applying leverage here. They're slow-walking the purchases. The U.S. said China agreed to buy 12 million metric tons, but we've only seen 2 tiny purchases so far.
And how can they do that? How do they have that leverage?
They have stockpiles. Multi-year high stockpiles. A record 10.3 million tons are sitting at their ports right now, so they can afford to wait. They're using U.S. soybeans as a political bargaining chip.
Speaking of political moves, President Trump just signed an order to reduce tariffs on some food items. Coffee, beef, bananas. It feels like a reversal of his tough talk.
It is a remarkable reversal. He's moving from trade war rhetoric to using tariff rollbacks to fight rising prices at home. But, Treasury Secretary Scott Bessent had to give everyone a fiscal reality check. President Trump floated this idea of sending $2,000 tariff dividend checks to Americans, and Bessent had to clarify that a payout like that would absolutely require congressional approval.
So after all that, what does this mean for you, the listener? We've covered the deep skepticism around the AI market, but also the incredible multi-decade conviction from big investors. We've tracked sharp political and geopolitical volatility from the Fed's data crunch to the allegations against Alibaba, right down to the price of soybeans.
And I think the theme connecting all of this volatility is the increasing degree to which governments are now inserting themselves directly into markets. It's easy to focus on the day-to-day of the stock market, but what happens when the government itself becomes a massive strategic investor?
And that's where this gets really interesting, thinking about the changing face of capitalism.
Well, exactly. The U.S. government, driven by national security think rare earths, semiconductors, has strategically taken equity stakes in public companies. We're talking a 9.9% stake in Intel and a 15% stake in MP Materials. This is a huge break from traditional free market ideology. And here's the kicker. According to the data we looked at, this government portfolio is currently outperforming the S&P 500. It sets a powerful and maybe controversial new precedent for government intervention that you should definitely be watching closely.
And with that deep dive complete, we'll see you all tomorrow morning with new headlines from major financial magazines.